Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
After listening to today's news, you'll know, first, Ukraine strikes a Russian oil tanker in the Mediterranean, escalating kinetic risk for global energy markets and sanctions evasion. So we'll discuss why this unprecedented attack challenges Russia's sanctions model and what it means for global oil prices and insurance premiums. Second, US median home price hits a record November high of $409,000 as inventory plunges, creating a deepening K-shaped market. Today, we'll take a closer look at the mortgage rate lock-in effect driving this seller's strike and its implications for shelter inflation and Fed policy. Third, 9 pharma giants like Merck strike a deal with the Trump administration, slashing drug prices in exchange for a tariff exemption. This discussion will reveal how the deal pressures European healthcare systems and what it means for a potential transatlantic trade dispute over drug pricing. Ukraine has just expanded the maritime conflict with Russia in a stunning way, striking a tanker not in the Black Sea, but in the Mediterranean Sea, a staggering 1,250 miles from its own borders. This is the first such strike of the war, and it targeted a key piece of Russia's economic war machine, the Shadow Fleet. And this Shadow Fleet is more than just a few rogue ships. This is an armada of more than 1,000 vessels used to evade international sanctions and keep oil revenue flowing into Moscow's war chest. Actually, these ships often use deceptive tactics, like disabling their tracking transponders or falsifying documents to hide their movements. The situation presents a fascinating duality. Financial sanctions are a form of economic pressure, but this attack is direct kinetic pressure. It physically tests the viability of Russia's entire sanctions evasion model. This also creates a serious dilemma for the primary buyers of this discounted Russian oil. For example, China's crude oil imports from Russia hit a record high in 2024, averaging 2.17 million barrels per day. This new kinetic risk forces countries like China to weigh the benefit of cheap energy against the rising insurance and security costs of transport, potentially altering global oil trade flows. The timing of this attack represents a direct and audacious challenge. It took place on the very same day Russian President Vladimir Putin publicly vowed that his country would definitely respond to Ukrainian attacks on these tankers, which he has previously derided as piracy. According to sources in the security service of Ukraine, the tanker, identified as the Qendil, sustained critical damage off the coast of Libya. They declared the vessel, which was being used to circumvent sanctions, an absolutely legitimate target. This isn't just an isolated incident, it's a strategic escalation with immediate global economic consequences. Here's where it gets interesting. This escalation will almost certainly force maritime insurers to expand their high-risk zones and hike premiums, just as we saw during the Red Sea crisis. This acts like a direct tax on global trade, increasing shipping costs for all goods, not just oil. On top of that, this attack reintroduces a significant geopolitical risk premium into global oil prices. A risk premium is simply the extra cost buyers are willing to pay because of fears that supply could be disrupted. Just to put that in perspective, before this, analysts at Goldman Sachs already estimated that existing tensions had added about a $10 per barrel risk premium to the price of Brent crude. Higher and more volatile energy costs could complicate the global fight against inflation, potentially forcing central banks to maintain higher interest rates for longer. The operation demonstrates a new and far-reaching threat to Russia's sanction-busting logistics network, which is already facing increased pressure from the US and European nations. This all happens as Ukraine issues its most defiant statement on the matter yet. A security service source made their intentions clear, stating, "The enemy must understand that Ukraine will not stop and will strike them anywhere in the world, wherever they may be." While global energy prices are adding to inflation fears, another major factor is heating up right here at home. The US housing market, which just did something completely unexpected. Despite sales stalling, the median home price just hit a record November high of over $409,000. The story begins with a decision that caught everyone by surprise. It's not a drop in demand, but a collapse in supply, and the numbers are staggering. The total inventory of homes for sale just plunged 5.9% in a single month. Sellers are pulling their properties off the market at a higher rate than usual, creating a massive supply squeeze right before winter. According to the National Association of Realtors chief economist, homeowners are in no rush to sell. A while back, we talked about this seller's strike delistings running roughly 45% higher year to date, with about 6% of active listings vanishing each month. The latest drop in inventory is that same behaviour now showing up in the November data, not just a seasonal slowdown. So the thing is, this all comes down to a phenomenon called the mortgage rate lock-in effect. A vast majority of current homeowners are sitting on mortgages with ultra-low interest rates, many below 4%. Why would they sell and give up that cheap loan only to buy a new home at today's much higher rates? The financial penalty is huge. And the scale of this is immense. Recent data shows that over 80% of homeowners with a mortgage have a rate below 6%. This is the core reason so few homes are being put up for sale. And it's not just the existing home market. This supply problem also extends to new construction. This decision to rely on imports brings both benefits and comes with inherent risks. To increase housing supply and lower prices, the US needs these imports, especially from a key supplier like China. But this runs counter to other trade policies, creating a tricky situation. But that's not the whole picture. The real turning point is how the market is fracturing right down the middle. While sales of homes under $250,000 collapsed by nearly 8%, sales of homes priced over $1 million are actually growing. A while back, we also highlighted refuge markets, smaller, more affordable metros, still seeing price gains even as former hotspots stalled. Today's split by price tier rhymes with that geographic bifurcation. Same story, different lens. This is a classic example of what economists call a K-shaped market. You see, the wealthy whose finances are often tied to a booming stock market are less sensitive to high mortgage rates. They can often pay in cash or are simply able to absorb the higher costs. Meanwhile, the average family and first-time buyers are being crushed by affordability issues, causing the lower end of the market to collapse. This all begs the question, who is still buying? It's not first-time buyers. They're stuck, making up just 30% of sales, a historically low figure. The real story is investors, they are stepping back into the market in a big way, snatching up 18% of all homes sold, a sharp increase from just 13% a year ago. That's the new twist today, on top of the seller retreat we flagged earlier. Investors are filling the gap. This trend has a direct impact on everyone, even those who aren't buying. When investors buy up a significant portion of available homes, especially entry-level ones, they are directly competing with first-time home buyers. Many of these investor-owned properties then become rentals. This increased competition for a limited housing stock can keep rental prices stubbornly high, contributing to shelter inflation, a major component of the overall inflation that the Federal Reserve is trying to control. Remember, we noted before that if sellers eventually capitulate with price cuts, shelter inflation could cool faster. The latest data points the other way for now because supply is still vanishing and prices just set a November record. So the bottom line is the housing market isn't just expensive, it's splitting in two. While the wealthy and investors are finding opportunities, the supply for everyone else is vanishing. This combination of record prices and disappearing inventory is creating a brutal landscape for the average home buyer, pushing affordability further out of reach. Looking ahead, this severe lack of supply is likely to put upward pressure on home prices again, especially as we head into the spring buying season. This could challenge the Federal Reserve's efforts to bring inflation down, making monthly housing inventory data a critical indicator to monitor. From the high cost of shelter to the high cost of staying healthy, affordability is the theme of the day. And believe it or not, a landmark deal was just struck that could change the price of prescription drugs in the United States. 9 of the world's largest pharmaceutical giants, including Merck and Bristol Myers Squibb, just struck a deal with the Trump administration to voluntarily slash drug prices. And the terms are stunning. Bristol Myers Squibb will now offer its blockbuster blood thinner, Eliquis, for free to Medicaid patients. That's its top prescribed product, now with a $0 price tag for the program. And the cuts go deeper. Sanofi and Merck are offering discounts of nearly 70% on major drugs for diabetes, infections, and cardiovascular conditions. Amgen is cutting prices on its preventative migraine medication and an autoimmune treatment by 60 and 80% respectively. However, if you zoom out, you'll see another layer of strategy at play. While these headlines are shocking, their actual impact on overall inflation might be smaller than you think because, these deals are very targeted. When we place this deal alongside broader policies like the Inflation Reduction Act, the difference in potential impact becomes clear. The IRA which gives Medicare power to negotiate prices for a wider range of drugs, is expected to have a much more significant and lasting effect on healthcare costs. But this isn't a one-way street. In exchange for these dramatic price cuts, the 9 drug makers secured a 3-year exemption from planned pharmaceutical-specific tariffs. The agreement hinges on a crucial condition. These companies must increase their investment in US manufacturing. From the perspective of these pharmaceutical giants, this is a masterful strategic move. What really brought this to a head was the realization that these price cuts can be seen as a loss leader. The companies are accepting a manageable, targeted loss on some products to secure something far more valuable, a 3-year exemption from potentially crippling tariffs and a great deal of regulatory goodwill. They are essentially managing their political risk. Now, regarding the condition to invest in US manufacturing, we need to be realistic. Research suggests this kind of deal-making is often less effective at reshoring supply chains than large-scale legislated programs like the CHIPS Act. The real test will be to watch whether these firms truly commit new capital to building up the US pharmaceutical supply chain. This is all part of a larger strategy to tackle what the administration calls global freeloading. US President Donald Trump declared the agreements represent the greatest victory for patient affordability in the history of American healthcare. The goal isn't just to lower costs at home. Merck's CEO publicly stated he is 100% supportive of the administration's actions to get prices up outside the United States. This is where the situation takes a more complex turn, bringing a core global tension into sharp focus. The administration's policy is essentially an ultimatum to other developed countries, particularly in Europe. The logic is if US patients get a discount, someone else has to pay more to make up for it. This directly challenges the single-payer healthcare systems common in Europe, which have long negotiated much lower prices. The risk is that it could trigger a new serious trade dispute between the US and the European Union, centered entirely on healthcare costs. A 2024 RAND Corporation study confirmed that US prescription drug prices average nearly 3 times higher than overseas. For brand name drugs, the difference is even more stark, with Americans paying more than 4 times the price. So what's the upshot of all this? There are a few key things to monitor. First, the official reactions from European governments. Will they push back? Second, the quarterly financial reports from these 9 pharma companies to see if capital expenditures for US manufacturing truly increase. Finally, the monthly prescription drug inflation data. This will be the ultimate test of whether these deals translate into broader relief for American consumers.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.